Hello and welcome back to Duca's Copy TV. Now, in these financially challenging times, credit agencies seem to be at their most active, or perhaps more publicly active. Only recently, the agency Moody's have announced a 26-bank downgrade from some of the Italian banks. Now, do we actually need credit agencies? Are they becoming more powerful, or are they an essential monitoring tool in today's ever-changing financial environment? Well, joining me to discuss this a little bit more is Dr. Harald Hau, Professor of Economy and Finance at the University of Geneva and the Senior Swiss Chair of the Swiss Finance Institute. Thanks very much for coming into the studio.
Thanks for inviting me.
No problem. Harold, we've seen agencies like Moody's downgrade Italian banks recently. In fact, on Moody's actually recently released a statement saying the ratings of Italian banks are now amongst the lowest within advanced European countries. Why is it important we have credit agencies, and why is it important we take notice of such announcements?
Well, to study, given the central role of credit ratings in our financial system, what we undertook in a big study is to focus on particular bank ratings, because they are of great importance. Banks have a lot of exposure to unobservable risk. They are highly leveraged. They are very complicated organizations to rate, and that's why our study focuses on the quality of credit ratings for banks. And we took a big sample of 20 years of bank ratings for all the major banks wherever we had public data, and looked at how accurate are bank ratings.
And you said to me earlier before the interview that sometimes banks and credit agencies have been known to be perhaps too close. Is this study also, will this also help clarify certain positions between banks and credit agencies?
Yeah, there's a lot of criticism. Some say or accuse these rating agencies of not having foreseen the crisis. Therefore, credit ratings, even a few days before the default of Lehman, were still investment grade quality. These sort of pickings or examples show that there's maybe a problem with grading, with credit ratings and the agency itself. There are either the ability to foresee these risks is not there, or secondly, there might be agency problems, meaning conflicts of interest between banks and credit raters that deteriorate the quality of these very important measures of default risk. These credit ratings in the investment range, meaning from AAA to A-, in normal times have relatively little, or not to say almost no, information content. That's very important to see. If we talk about a lot of fuss being made about a bank being downgraded from a AAA to a AA or even lower, from a purely empirical point of view, this does not correlate with any increase in future default frequency, according to our study. However, having said this, it's also true that in a financial crisis that we entered in 2008, for example, these credit ratings become relatively more informative, even for banks in the investment grade range. So in a way, if you want to put it very simple, the quality of credit ratings is counter-cyclical. In good times, they have actually a pretty low information content, and if the financial crisis arrives, their information content rises. It kind of explains why these credit ratings all of a sudden become so controversial during crisis, because that's the moment when they have relatively more information content.
So when they're at their most sort of volatile, if you like, it's suddenly they suddenly say, oh, we've actually got all this information, here it is, now you've got to deal with it.
Well, you have to understand credit risk is very much about extreme risks, about extreme situations. These extreme risks manifest themselves in a financial crisis. So the best situation to actually measure and to derive information from them is when the overall financial crisis system gets into a crisis. I think we are now in a situation where even small rating differences in the investment grade range actually have meaning for empirical default frequencies. This is not the case in good times like we had in the credit boom, in the boom years up to the crisis. There these ratings did not contain much information. It's now that we are entering into this in this relatively difficult moment of European banking stress, that these ratings actually take on a meaning, even in an empirical sense, a meaning of their own.
Okay, Dr. Hau, moving on to the future of regulation for banks. Are we going to see, we know that for some time perhaps some banks have wanted internal models, their own internal models. Are we going to see this happen perhaps in the future, or will it remain the same?
I mean, one of the big issues about internal models is that that they might be gamed, that they might be abused in order to reach and get along with much lower capital requirements. So that's the big problem. Bank ratings seem to be systematically biased in favor of large banks. From a competitive point of view, that's a very big problem, given that the rating determine your refinancing costs. And one hope is maybe that we could have more evaluation or ratings, particularly for corporates, based on purely public data. But that would require that the regulators are willing to move to a regime of bigger bank transparency. We can get better ratings, and I think that's a way of the future. More transparency, more information disclosure, more competition, more public ratings, particularly in the corporate realm.
Dr. Hau, thanks very much for coming in the studio, and of course for sharing your paper results with us as well.
It was my pleasure.
That's all we've got time for at the moment on Dukas Copy TV, but stick with us as later on we'll be speaking to Hervé Pretre from Credit Suisse about Europe and of course once again the problems in Greece. But until next time, goodbye.